Welcome to the Deep Dive. Today we're going to try and cut through some of the complexity around a really foundational part of the global economy, currency and commodity futures. This deep dive it's designed to arm you with the surprising facts, the crucial insights you need to really understand what drives these powerful markets.
It's true. And while these assets might seem a bit intimidating at first glance, their movements are constantly shaped by, relatable real-world events.
Right.
So our goal today is really to peel back the layers, show you the forces at play, and highlight the key indicators you should probably watch, whether you're just starting out or, looking to sharpen your market understanding.
Okay.
We'll be drawing insights from a pretty comprehensive module on these topics, kind of guiding you through the essentials.
Great. So let's maybe start with currencies. Have you ever stopped to think, why isn't €1 just worth 1 rupee or $1? Sounds almost basic, doesn't it?
It does, but the answer really reveals the foundation of global trade. Understanding this difference, it helps explain why currency trading even exists in the first place. For centuries, people struggled with the old barter system.
Right. Inefficient.
Incredibly inefficient. Imagine trying to trade, say, half a cow for a bale of cotton. Divisibility, scalability, huge problems.
Yeah.
So this eventually led to the goods for metal era. Gold and silver became common denominators because, they were divisible, portable, and crucially, they didn't spoil.
Right. They lasted. And then came the gold standard, where currencies were actually tied directly to gold. But as global trade just exploded and, geopolitical trust became more valuable, how did countries sort of manage their money relationships then?
Yeah, that's where the Bretton Woods system came in after World War II. It essentially pegged major currencies to the U.S. dollar at a fixed rate.
And the dollar was backed by gold itself.
Exactly. The dollar was backed by gold. This really made the USD the world's go-to transactional currency, streamlined global commerce. But as developed countries got stronger economically, they eventually moved away from this fixed system, which brings us to where we are now, this kind of market-driven approach.
Where values shift constantly.
Constantly shifting, based on a whole mix of political and economic forces.
So given that whole evolution, just how massive is this market today? It's almost hard to really picture the scale of daily currency trading.
Oh, it's truly staggering. Back in 2013, the international currency market was trading something like $5.4 trillion every day. And estimates put it closer to maybe 5.8, even $6 trillion by 2016. I mean, put that in perspective, that's roughly 20% higher than India's entire annual GDP.
Traded daily.
Traded every single day. It's mind-boggling.
That volume is incredible. What's driving all that activity day in, day out?
Well, a big part of it is the market literally chasing the sun. When Asian markets like Tokyo and Hong Kong are open, European hubs like London and Frankfurt join in. Then New York opens. It's this continuous cycle, keeping the market humming 24 hours a day, 6 days a week.
And who are the players doing all this trading? It can't just be speculators.
Oh, absolutely not. It's a whole ecosystem. You've got central banks managing reserves, big corporations handling international payments, banks facilitating trade, even travelers exchanging money for trips.
Right.
And yes, of course, there are speculators too. Plus, you have to remember, forex trading is often highly leveraged. That leverage naturally inflates those huge notional values we see.
So when we actually talk about trading currencies, we never trade them just one by one, do we? It's always in a pair.
Yeah.
Like USD-INR.
That's exactly right. The standard format you'll see is base currency, quotation currency is value.
Okay.
The base currency is always fixed at 1 unit, like $1, and the quotation currency shows its equivalent value, maybe, say, 67 Indian rupees.
Right.
So USD-INR equals 67 just means $1 equals 67 rupees. Simple as that.
But here's a really crucial point, I think. When you buy a currency pair, say USD-INR, you're not just taking a view on one currency, are you?
No, absolutely not. You're making a kind of dual assessment. If you buy USD-INR at 65, maybe hoping it goes up to 68, you're obviously bullish on the US dollar.
Right.
But you're also implicitly bearish on the Indian rupee. It has to be that way.
Because the pair's value is relative.
Exactly. As the pair's value rises, the base currency strengthens, or we say it appreciates, and the quotation currency weakens or depreciates. Those terms, strengthening, weakening, appreciating, depreciating, they're interchangeable, really.
Got it. And just like stocks, currencies have that two-way quote too, right? A bid and an ask.
Correct. So let's take UR2SD. A quote might look like 1.126970.
Yeah.
That means you buy at 1.1270, that's the ask price, and you sell at 1.1269, the bid price.
And those last digits, those are the pips.
Yes, exactly. That smallest unit of price movement, typically the fourth decimal place for most pairs, is called a pip, which stands for percentage in point. So if USD moves from 1.1270 up to 1.1272, that's a 2-pip move.
Okay, that makes sense. So how are these rates actually decided or set? Let's take USDNR again.
Right. For USDNR, the Reserve Bank of India, the RBI, sets a daily reference rate. They do this by polling a select group of contributing banks around midday between 11:30 a.m. and 12:30 p.m.
And they average the quotes.
They average the two-way quotes they get from those banks, yeah. For other major pairs like EUR/INR, GBP/INR, JP/INR, the RBI uses something called a crossing technique.
Crossing.
Yeah, they typically use the US dollar as the common denominator. So to figure out the EUR/INR rate, they'll essentially look at the prevailing USD/INR rate and the USDA rate and calculate it from there.
Okay, I see. So what ultimately influences the sentiment of these banks and therefore the rates they quote?
Well, it boils down to a constant interplay of domestic and international events. It's quite different from equities, you know.
How so?
Well, with a stock, good company results usually mean the price goes up fairly linearly.
Right.
But currency pairs are more complex. You could have two things happening at once with opposite effects.
Like what? Give me an example.
Okay, say you have significant foreign direct investment, FDI, flowing into India, which should strengthen the rupee.
Right.
But at the same time, maybe the U.S. economy is looking really strong, which strengthens the dollar. So USD/INR gets pulled in both directions.
Okay. So one factor eventually wins out.
Usually, yes. The dominant factor will eventually set the direction, but that push and pull can definitely lead to volatility in the meantime.
So for someone trying to follow currencies, what are some of the key economic indicators they should really be watching?
Okay, good question. Import-export data is a big one, especially for countries like India. That's often called the trade deficit or the current account deficit.
And a smaller deficit is good for the currency.
Generally, yes. A narrowing deficit usually signals a stronger domestic currency. Then there's interest rates. They're a major driver.
Because it's carry trades.
Exactly. They power those carry trade strategies. Investors borrow where rates are low, invest where they're high, and that tends to strengthen the higher interest currency.
Makes sense.
Central bank monetary policy reviews are huge. Everyone watches for dovish signals hinting at lower rates, maybe a weaker currency, or hawkish signals suggesting higher rates and a stronger currency.
Hawkish means tighter policy.
Right. Then there's inflation, usually measured by the CPI, the Consumer Price Index. High inflation often pushes central banks towards a hawkish stance, strengthening the currency.
Okay.
And finally, gross domestic product, GDP growth rates. Stronger growth usually boosts investor confidence, which naturally strengthens the domestic currency.
We saw a really massive real-world example of these forces with Brexit, didn't we? The UK's vote to leave the EU back in June 2016, the pound just plummeted.
Oh, absolutely. It dropped, 8.64% overnight? A huge move for a major currency.
Why such a dramatic reaction?
It was classic uncertainty shaking the market. The UK deciding to leave after decades of integration with Europe, it just introduced immense financial and economic questions.
Because the EU was a single market.
Yes, a single market for goods, services, people. Deep trade ties. The market reacted so violently because everyone knew the UK's finances, especially its big trade surplus with the EU, were likely going to take a hit.
But nobody knew how much.
Exactly. That unknown impact plus questions about how the Bank of England would react, it just fueled widespread fear. And for currencies, uncertainty really is kryptonite.
Let's switch gears slightly. There's this concept that sounds almost too good to be true, like a fairy tale trade. Imagine borrowing, say, $10,000 in the U.S., where interest is maybe 0.5%. You convert it to Indian rupees, invest it in India, where rates are, say, 7%.
Okay.
Then a year later, you convert it back to dollars, repay the loan, and pocket a seemingly risk-free $650 profit.
Sounds great.
That sounds fantastic, but it absolutely is too good to be true.
Why?
Because such easy, risk-free arbitrage opportunities just don't last in efficient markets. This scenario is a perfect illustration of something called interest rate parity.
Interest rate parity, okay. The key is that the exchange rate you get a year later, the forward rate, or what reflects the forward premia, it adjusts precisely to wipe out that easy profit.
How does it adjust?
In essence, the currency with the higher interest rate in your example, the rupee will trade at a discount in the future market. The difference in the forward rate versus the spot rate cancels out the interest rate difference.
Ah, so the market anticipates the interest gain and prices it in.
Exactly. It prices it in. This principle is absolutely fundamental if you want to understand how futures prices are determined.
Okay, let's get practical then.
Yeah.
Trading USD-INR futures in India. What are the nuts and bolts?
Right. So for the main USD/INR futures contract, the lot size is fixed at $1,000.
Okay, $1,000.
Yeah. It's quoted to the fourth decimal place, and the minimum price move, the tick size, is 0.0025.
Right, the pip value we discussed.
Well, sort of. The tick size here is 0.00025 rupees. So for every one tick move, you make or lose 2.5 rupees. Ours 2.5.
Okay, ours 2.5 per tick.
Yeah. And here's a striking thing, the margin required. It's only about 2.25% to 2.5% of the contract value.
That seems low compared to stocks.
It is significantly lower than equity futures. It really underscores how leveraged currency trading can be, even though currencies themselves often trade in tighter ranges than stocks.
And expiry.
Contracts usually expire 2 working days before the last working day of the month, and they settle based on that RBI reference rate we talked about earlier.
What about options? Can you trade options on USD-INR?
Yes, you can. USD/INR options are available. They're European style.
Meaning you can only exercise them at expiry.
Correct. Only at expiry. The premiums are quoted in rupees, and contracts are typically available for 3 months out. You get around 25 different strike prices, usually at 0.25 paisa intervals.
And if you sell options?
Same as equities, you'll need to block margin if you're writing or selling options.
Okay. Now, you mentioned that simple spot future arbitrage isn't really feasible for retail traders. So how would someone trade spreads in currencies then?
Good question. You typically use what are called calendar spreads.
Calendar spread.
This involves buying one futures contract and simultaneously selling another contract for the same currency pair, but with a different expiry date.
Ah, okay. Buying 1 month, selling another.
Exactly. The longer dated contract is normally expected to trade at a premium due to that interest rate parity idea. Opportunities pop up when the difference, the spread between those two contracts, deviates from its usual historical range.
And you can trade that spread directly.
Yes, most trading platforms allow you to execute these calendar spreads as a single order.
So stepping back, what does the actual data tell us about the USD-INR pair itself? Has the dollar consistently gone up against the rupee?
Generally speaking, yes. Over the last 8 years or so, the US dollar has strengthened against the Indian rupee. But here's something that might surprise you.
What's that?
Its average daily return is actually tiny, only about 0.025%.
Really? That low?
Yeah. And its daily volatility is also lower than you might think, about 0.57% compared to, say, the Nifty 50 equity index, which is closer to 0.82%.
Interesting. And what about its relationship with the Nifty? You hear people talk about that.
They often show an inverse correlation, meaning they tend to move in opposite directions.
Why is that?
Well, think about it. If Indian markets are doing really well, they attract foreign investment, right? That means US dollars flow into India.
Which strengthens the rupee.
Exactly. More demand for rupees pushes the rupee up, which means the USD/INR pair goes down. So strong Nifty often equals lower USD/INR. Back in 2015, for example, that correlation was negative 0.12.
Okay. So we often hear these little sayings in the market like, oh, USD/INR always tanks in December. Is there actually any statistical basis for that kind of seasonality?
It's a great question to ask because you hear that stuff all the time.
Yeah.
We actually looked at this using a statistical test called Holt-Winters on about 8 years of historical USD/INR spot data.
Oh.
And the result was clear. There is no statistically significant weekly or monthly seasonality.
So it's just noise.
Pretty much just market chatter, yeah. Those random statements don't really hold up to statistical scrutiny.
Okay. So given how complex fundamental analysis can be for currency pairs, with all those interacting factors, what's a more accessible approach for many traders?
For many, especially those with shorter time horizons, it comes down to technical analysis.
TA.
Because it simplifies things.
In a way, yes. TA works on the assumption that all the fundamental news, all the expectations, all the economic data, it's already reflected or discounted in the price you see on the chart.
So you just analyze the price patterns.
Exactly. It applies to currencies just like it does to stocks or anything else that's traded. You look for patterns, trends, support, resistance, use indicators to identify potential trade setups directly from the charts.
Right. Now, beyond the main USD/INR pair, what other currency pairs can you actually trade in India?
You could also trade EUR/INR, GBP/INR, and JPY/INR, Euro, Pound Sterling, and Japanese Yen against the rupee. And they work similarly.
Yes, their overall functioning, contract specs, the trading mechanics, they're quite similar to USD INR.
One thing that's kind of interesting about the euro is that its value isn't tied to just one country's economy, is it?
That's a key difference, yes. It reflects the collective economic health or perceived health of the many Eurozone economies.
And the contract details for these others.
Sure. The EUR/INR contract has a lot size of 1,000 euros. Margins are similar to USD INR. GBP INR, the pound, is probably the second most popular cross.
Okay.
It has a lot size of 1,000 pounds sterling. Fun fact, internationally, the GBP-USD pair is often nicknamed the cable.
The cable, why?
Oh, it's a historical thing. Back in the day, the exchange rate was literally transmitted between London and New York via a transatlantic telegraph cable. The name stuck.
Okay. And the yen?
JPY-INR contracts are a bit different. The lot size is 100,000 Japanese yen. It's quoted per 100 JPY.
A bit confusing.
A little bit, yeah. And they tend to have the highest margin requirements in the currency segment, maybe because liquidity isn't quite as deep as the others.
So if liquidity is a concern, what's the general pecking order for these currency futures?
Right. Generally, you'll find the most liquidity in USD-INR futures. That's number one.
Okay.
Then probably USD-INR at the money options. After that, GBP-INR futures, then EUR/INR futures. And finally, JPY/INR futures usually has the least liquidity.
Got it. Okay, let's shift gears now and dive into commodities, starting with the big one, gold. How can people trade gold in India?
Gold is very liquid, very popular on India's multi-commodity exchange, MCX. It comes in a few different contract sizes, which is helpful.
Like what?
You have the main one, often called big gold. Then there's gold mini, gold guinea, and even gold petal.
Big gold sounds, well, big.
It is. It's quoted per 10 grams, but the actual lot size is 1 kilogram, 1 kilo of gold.
Wow, okay. What does that mean in value terms?
Well, depending on the price, a single contract can easily be worth over 30, maybe 31 lakh rupees.
So the margin must be pretty high too.
Relatively, yes. Over 1.25 lakhs typically, which works out to around 4% of the contract value. And for every 1 rupee move in the price per 10 grams, you make or lose Rs 100 on the contract.
Okay, Rs 100 per tick. That's a hefty contract.
Right.
What about options for smaller investors?
That's where Gold Mini comes in. It offers a much more accessible entry point. The lot size is 100 grams.
So 1/10 the size.
Exactly. The margin is much lower, maybe around Rs 15,000, and the profit or loss per tick is Rs 10.
More manageable. What about gold guinea and petal?
They're even smaller. Guinea's 8 grams, petal is just 1 gram. But honestly, they suffer from very low liquidity.
So hard to trade actively.
Very hard, yeah. Most active traders stick to big gold or gold mini.
Now, expiry dates and delivery. That seems like a really crucial difference for commodities compared to, say, equity futures.
It is. It's a key distinction. Gold contracts are typically introduced every 2 months, and they stay listed for trading for about a year. They expire on the 5th day of the contract month.
And delivery.
Unlike equity futures, which are cash settled, physical delivery is compulsory for gold futures if you hold your position into the tender period.
Tender period.
That's usually the last 4 days or so before expiry. If you're still holding a long position, then you could be obligated to actually take delivery of the physical gold.
And if you're short,
You'd be obligated to deliver it. But practically speaking, most brokers.
they force you out.
Yeah, platforms like Zeroda and others will typically auto-square off your position or require you to close it well before the tender period starts, precisely to avoid anyone accidentally ending up with a physical delivery obligation.
Okay, that's important to know. How do international gold prices, like the famous London fix, connect with the prices we see on MCX in India? Is it a direct link?
It's related, but not direct one-to-one. Internationally, you have the London fix, which sets benchmark prices twice a day. It's almost symbolic now, done by major bullion dealers.
Okay.
In India, the Indian Bullion and Jewelers Association, IBJA, sets a sort of floor price, which is heavily influenced by the cost of imported gold. Import costs.
Exactly. And that includes significant import duties and taxes levied by the Indian government. This is the main reason for the gold price disparity you often see.
Disparity between, say, London and Mumbai.
Yes, India's spot gold price is inherently higher because of those duties and taxes. And that difference naturally feeds into the futures prices on MCX being different from futures prices on, say, the CME in the US.
Got it. So fundamentally, what really drives the price of gold? Why do people rush to it?
Well, the key insight, the classic role for gold, is as a safe haven asset.
Safe haven.
During times of economic turmoil, political instability, geopolitical uncertainty, think back to Brexit or the financial crisis,
People buy gold.
investors tend to flock to gold, yeah. It's seen as a store of value when other assets look risky. That increased demand drives up the price.
And its relationship with the US dollar.
Historically, gold often shows an inverse relationship with the US dollar. When the dollar falls, gold often becomes more attractive as an alternative investment, pushing its price up.
But it's not always perfect. No, it's not always a perfect inverse correlation. It can break down sometimes, but it's a tendency worth watching.
So given all these global factors influencing gold, what's a practical approach for someone actually looking to trade it?
Honestly, given the complexity of tracking global gold fundamentals, central bank buying, jewelry demand, mine production, geopolitical tensions, dollar movements, it's a lot.
Yeah.
Many traders, myself included, find that technical analysis is often the most practical approach, especially for shorter time frames.
Back to TA.
Back to TA. It directly reflects the supply and demand pressures playing out on the charts, which simplifies the decision-making process considerably.
Okay. What about silver? Does it play a similar safe haven role? Is it just poor man's gold?
Haha. Well, it definitely plays a similar role. Gold and silver are often called the bullion twins.
Bullion twins.
Yeah, because they exhibit a really strong positive correlation, usually around 0.7 to 0.8, sometimes even higher, both intraday and on an end-of-day basis.
So they tend to move together. Does that offer trading opportunities?
It certainly can. That strong correlation opens up possibilities for strategies like pair trading.
Pair trading.
Yeah.
Betting on the ratio between them.
Exactly. Trading the relative performance. If you think gold is going to outperform silver or vice versa, even if both are going up or down, you can structure a trade around that relationship.
Interesting. Now, despite that tight correlation, their charts can sometimes look quite different, can't they? What else affects silver specifically?
That's a key point. Unlike gold, silver has significant industrial demand.
Industrial use. Like what?
Oh, lots. Fabrication, electronics, its highly conductive solar panels, even traditional photography, although that's declining.
So its price is also tied to economic growth.
Yes, definitely. Global industrial growth, particularly in big consumers like China and India, has a noticeable impact on silver demand and therefore its price. There's also a supply side currently. Global demand for silver tends to slightly outstrip new mine supply, meaning there's a persistent structural deficit.
Okay. And how are the silver contracts structured on MCX? Similar to gold?
Similar concept, different specifics. There are 4 main variants for silver, too. The main one is just called silver.
Big silver.
Basically. The lot size is 30 kilograms, quoted per kilogram.
30 kilograms.
Yeah. The profit or loss per tick, which is RE1, is RS30. Margin is around 5.4%, maybe a bit higher than gold.
Then delivery.
For this main contract, physical delivery is compulsory if held to expiry, just like big gold.
Okay. What about the smaller ones?
This is where it gets interesting. There's Silver Mini, which has a 5 kilogram lot size, and Silver Micro, with just a 1 kilogram lot size.
More accessible.
Much more. And crucially, for both Silver Mini and Silver Micro, you have the option for cash settlement or physical delivery.
So you're not forced into delivery.
Exactly. That flexibility makes them much more suitable for retail traders who just want financial exposure without worrying about taking delivery of physical silver bars.
That makes sense. Now, a practical question that comes up with commodities. If there are multiple physical markets, like different cities where silver is traded, which spot price does the futures contract actually track and converge to at expiry?
That's a really critical detail for settlement. MCX explicitly maps each commodity contract to a specific designated physical spot market.
Okay.
So, for example, the Silver Micro futures contract is officially mapped to the spot market in Ahmedabad.
I see. So the futures price will converge to the Ahmedabad price.
Precisely. This ensures there's a clear single benchmark for the futures price to converge with on the expiry date. No ambiguity.
And for trading silver, TA again.
Yes. Given silver's generally good liquidity, especially in the main and mini contracts, technical analysis works very well.
Okay, let's move to probably the most talked about commodity, certainly the most volatile sometimes, crude oil. We all remember that insane crash, right? From $115 down to below $30 a barrel between 2014 and 2016. What on earth caused that manic panic?
Oh, that was a perfect storm, really. Several major factors came together.
Like what? First, you had the massive rise of American shale oil. New technology unlocked vast reserves in the U.S., providing a cheaper, abundant alternative supply,
Disrupting OPEC.
hugely disrupting traditional supplies from OPEC and other non-OPEC producers like Russia. Second, there was a real lack of coordinated action among those producers to cut supply and stabilize prices.
Why didn't they cut?
Well, partly because cutting production isn't always straightforward or cheap. Sometimes it's actually more expensive to shut down wells than to keep pumping, even at lower prices. And political disagreements within OPEC didn't help.
Okay, shale oil, lack of cuts. What else?
Third, the China factor. China's economic growth started slowing down around that time.
Lower demand.
Lower demand from the world's biggest energy consumer. That definitely weighed on prices. And finally, you just had pure market dynamics.
Speculators.
Heavy short positions built up by hedge funds and other speculators. As prices started falling, those shorts piled on, intensifying the sell-off. It became a snowball effect. How did that massive price collapse hit different countries? Russia, for instance.
No, Russia's economy got hammered. They're heavily reliant on oil and gas exports.
Right.
The ruble tanked, inflation spiked, and their central bank had to jack up interest rates dramatically overnight to try and stop the currency's free fall. It was a major economic shock.
And what about India? We import most of our oil. Was it good news for us?
It was definitely a mixed bag for India. On the plus side, as a net importer, lower oil prices were a huge relief.
Reduced the import bill.
Exactly. It significantly eased pressure on government fuel subsidies and helped improve the fiscal deficit numbers. Big positive there.
But there was a downside.
Yes. India also exports goods and services to many oil-dependent economies, particularly in the Middle East. When their economy suffered due to low oil prices, our exports to those regions also took a hit.
Ah, okay. So could you quickly break down the different parts of the oil industry, the crude oil ecosystem, and how prices affect them?
Sure. Broadly, you can split it into three main segments. First is upstream.
Exploration and drilling.
Exactly. Exploration, drilling, extraction. These companies are generally negatively impacted by low oil prices. Their product is worth less.
That makes sense.
Second is downstream. This involves refining the crude oil into products like petrol, diesel, jet fuel, etc., and then distributing and selling them.
Like refineries and petrol pumps.
Right. These companies often benefit from low crude oil prices because their main input cost goes down, potentially boosting their profit margins.
Okay, so they have opposite interests sometimes.
Pretty much, yeah. It's often described as a seesaw relationship between upstream and downstream regarding oil prices. And the third segment is midstream.
Pipelines, tankers.
Yep. Transportation and storage. Pipelines, tankers, storage facilities. They generally prefer stable prices as volatility can disrupt flows and investment plans.
Got it. Now, we often hear about different types of crude oil like WTI and Brent. What's the actual difference? Is one better than the other?
They mainly differ in two key characteristics. API gravity, which is a measure of how light or heavy the oil is.
Lighter is better.
Generally, yes, lighter crudes are easier and cheaper to refine. And the second is sweetness, which refers to the sulfur content.
Sweet means low sulfur.
Correct. Low sulfur is sweet, high sulfur is sour. Sweet crude is also preferred because it requires less processing and meets stricter environmental standards.
So how do WTI and Brent compare?
WTI, which stands for West Texas Intermediate, is considered very high quality. It's very light and very sweet. Top grade stuff.
Okay.
Brent Blend, which is actually a mix of oils from different fields in the North Sea, is also light and sweet, but typically not quite as light or as sweet as WTI.
And which one does the MCX contract in India follow?
MCX's crude oil futures largely track the price of Brent crude, as that's the more common global benchmark outside of North America.
Okay, so if you're trading crude, what are the absolute key data points you need to keep an eye on?
Number one is definitely crude oil inventory levels.
Stockpiles.
Exactly. Particularly the weekly reports from the U.S. Energy Information Administration, the EIA, and also broader data from the OECD countries.
And what do those inventory numbers tell you?
Generally, if inventories are building up unexpectedly, it suggests either demand is weak or supply is too high. Both are usually bearish or bad for prices. Falling inventories suggest strong demand or tight supply, which is usually bullish.
Makes sense. What else?
Also, keep an eye on that relationship with the U.S. dollar index.
The inverse relationship again?
Usually, yes.
Wow.
Crude oil is priced globally in U.S. dollars. So if the dollar strengthens significantly, it makes oil more expensive for buyers using other currencies, which can dampen demand and push prices down, and vice versa if the dollar weakens.
Got it. So what are the actual contract specs for trading crude on MCX?
Right. Crude oil is actually MCX's most actively traded commodity by volume. Huge liquidity.
Oh, okay.
You have the main contract, the big crude. The lot size is 100 barrels.
100 barrels.
Yep. And the profit or loss per tick, which is RE1, is RS100.
Mm-hmm.
There's also a crude oil mini contract.
Smaller size.
Much smaller, only 10 barrels per lot. So the P&L per tick is just RS10, makes it much more accessible.
And margins. Are they high for crude?
They're higher than currencies or gold, definitely. For the big crude contract, overnight margins are typically around 9%, maybe higher, depending on volatility.
And expiry and delivery.
Contracts usually expire around the 19th or 20th of each month. And yes, physical delivery is technically applicable, although, again, most retail traders will be squared off by their brokers well before expiry.
Okay, now here's an interesting question. If both the big crude and the crude oil mini contracts represent the exact same underlying asset, Brent crude, basically, shouldn't they always trade at the exact same price?
Logically, yes. In a perfectly efficient market, they should trade at the same price, adjusted for the contract size difference, of course.
But do they always?
Not always perfectly, no. Sometimes tiny discrepancies can appear due to temporary imbalances in buying or selling pressure in one contract versus the other.
And if they don't trade at the same price?
Well, if that price difference becomes large enough to cover transaction costs, it creates a pure arbitrage opportunity.
Arbitrage. How would that work?
You'd simultaneously buy the contract that's trading cheaper and sell the one that's trading more expensive.
Okay.
But you have to adjust the quantities because the contract values are different, 100 barrels versus 10 barrels. So you might say, buy 10 lots of the crude oil mini and sell 1 lot of the big crude if the mini was cheaper relative to the big one.
And that locks in a profit.
If done correctly, yes. You lock in a small, virtually risk-free profit from the price difference, regardless of which way the overall crude price moves afterwards. These opportunities are usually very small and disappear quickly, though.
Right, the computers jump on them. Now, speaking of risk in energy markets, that infamous Amaranth natural gas gamble is a really stark warning, isn't it? What happened there again?
Oh, it's a classic cautionary tale about leverage and risk management. Amaranth Advisors was a big U.S. hedge fund.
Okay.
Back in 2006, they lost an absolutely staggering $6 billion in just a couple of weeks.
$6 billion? How?
Mostly due to massive, incredibly highly leveraged speculative bets on natural gas futures prices.
What was the bet?
Their star energy trader, a guy named Brian Hunter, had basically bet the farm on natural gas prices soaring due to predictions of harsh winter weather and potential hurricane disruptions to supply.
But the weather didn't cooperate.
Nature had other plans. The harsh weather didn't materialize as expected. Inventories built up, and natural gas prices plummeted instead of soaring.
And the leverage killed them.
The extreme leverage just magnified the losses exponentially. They couldn't meet margin calls, had to liquidate positions at fire sale prices. It was a complete collapse.
Wow. What's the key takeaway from that?
It just powerfully underscores the absolute paramount importance of rigorous risk management. Position sizing, diversification, stop losses. These things are often far more crucial to survival than actually predicting the market direction, especially when you're dealing with volatile markets and leverage. One bad, oversized bet can wipe you out.
A very sobering lesson. Okay, let's shift to base metals now. Copper, aluminium, etc.
Yeah.
There was another big scandal there too, wasn't there? The Sumitomo copper scandal.
Yes, another major event with risk management lessons. This was back in the 1990s. Sumitomo Corporation is a giant Japanese trading house.
Right.
Their chief copper trader at the time, a man named Yasuo Hamanaka, gained the nickname Mr. 5% because he allegedly controlled about 5% of the world's annual copper supply.
He tried to corner the market.
Essentially, yes. He built up massive positions in physical copper and also in copper futures contracts on the London Metal Exchange, the LME. For a while, he successfully manipulated prices upwards.
But it didn't last.
No. Eventually, the market dynamics turned against him. Reports suggest China, which wasn't as big a player then, but still significant, released a flood of its own copper inventories onto the market.
Crashing the price.
Exactly. Prices crashed, Hamanaka's positions imploded, and Sumitomo ended up reporting losses eventually estimated at around $2.6 billion, though some say the total impact was closer to $5 billion.
Another huge loss from one trader's actions.
Yes. It highlights the dangers of excessive concentration risk, trying to control or manipulate a global market, and the potential for unforeseen events to derail even seemingly dominant positions. Again, risk management failure.
So bringing it to today, what does this mean for trading base metals like copper and aluminum now, are they still actively traded?
Oh yes, both copper and aluminium are base metals, and they are quite liquid and actively traded on MCX.
What are they mainly used for?
Copper is actually the third most consumed industrial metal globally after iron and aluminium. It's absolutely vital for electrical wiring, electronics, plumbing, construction, basically anything related to conductivity.
Okay. And aluminum?
Aluminium is amazing stuff. It's the most abundant metal in the Earth's crust. It's lightweight, strong, corrosion resistant.
Used in cars and planes?
Heavily used, yeah. Automotive sector, construction, packaging, like cans, and especially aviation. A single Boeing 747 jumbo jet apparently uses something like 70,000 kilograms of aluminium.
Wow. So demand for these is tied to global industry?
Very much so. Demand and supply trends are obviously important fundamental drivers, but tracking global industrial cycles, LME warehouse stock levels, Chinese import-export data, it can be quite complex for daily or short-term trading.
So, PA again.
For many short-term traders, yes. Given the complexity of the fundamentals, technical analysis often becomes the more practical go-to approach.
Okay. Could you give us the key contract details for copper and aluminum on MCX?
Sure. For the main copper contract, the lot size is 1 metric ton, which is 1,000 kilograms.
1,000 kilograms.
Yep. The tick size is 5 paise, 0.05 rupees, and the profit or loss per tick is Rs50. Aluminium is actually a larger contract in terms of quantity. The lot size is 5 metric tons, or 5,000 kilograms.
5,000 kilograms.
Yeah. The tick size is also 5 paise, but because the lot size is 5 times bigger, the P&L per tick is Rs250.
Okay, 50 for copper, 250 for aluminum per tick. Do they have mini contracts too?
Yes, both copper and aluminium also have mini versions with smaller lot sizes, 250 kilograms for copper mini, 1,000 kilograms for aluminium mini, and correspondingly smaller P&L per tick, making them more accessible.
And their prices follow the LME?
Yes, prices on MCX for base metals like copper and aluminium closely track the benchmark prices set on the London Metal Exchange, LME.
Okay, moving on, there's lead and nickel. Lead has a rather unexpected historical connection, doesn't it?
Yeah.
Something about the Roman Empire.
Yes. It's a fascinating, though perhaps slightly speculative historical theory. The Romans used lead extensively.
For what?
Primarily for lining their aqueducts and for making water pipes, but also in things like pottery glazes and even sweetening wine sometimes.
So lead poisoning.
The theory goes that widespread chronic lead poisoning, particularly among the ruling and decision-making classes who use the most lead plumbing and utensils, may have contributed to cognitive decline and played a role, however small, in the eventual fall of the Western Roman Empire.
Wow. What's lead used for today, mainly?
By far the largest application today is in lead-acid storage batteries. Car batteries, backup power systems. That's where most lead goes.
Okay. And nickel?
Nickel is crucial for making stainless steel. That's its biggest use. It provides corrosion resistance and strength. It's also increasingly important in batteries, especially for electric vehicles.
So like copper and aluminum, these are also base metals tied to industry.
Exactly. Lead and nickel are base metals. Their demand and supply dynamics tend to be relatively stable compared to, say, energy commodities.
Okay.
Which again means that for short-term trading,
PA is the way to go.
it often makes the most sense, yeah. Interpreting daily price movements through technical analysis is generally more straightforward than trying to constantly track and react to the nuances of global battery production or stainless steel demand.
Makes sense. What about the contract specs for lead and nickel?
Okay. Lead on MCX has a lot size of 5 metric tons, just like aluminium.
5,000 kilograms.
Yep. Tick size is 5 paise. P&L per tick is Rs250. There's also a lead mini at 1 metric ton lot size with Rs50 P&L per tick. Interestingly, margins for lead tend to be among the highest in the commodity space, sometimes around 11% or 12%, perhaps reflecting slightly lower liquidity or specific risk factors.
Okay. And nickel?
Nickel has a smaller lot size, just 250 kilograms. Tick size is 5 paise. P&L per tick is Rs25.
250 kilograms, Rs25 per tick. Mini version.
Yes, there's a nickel mini too, with a 100 kilogram lot size and Rs10 P&L per tick.
And for trading these, liquidity-wise?
Generally, for both lead and nickel, it's advisable to stick to the nearest expiry month, the current month futures contract, as liquidity tends to drop off significantly in the further out contracts.
Okay, stick to the front month. Got it.
Yeah.
Let's switch tracks completely now and look at agricultural commodities.
Mhm.
People often talk about monsoon blues impacting trading here. Is that a real factor?
Oh, absolutely. It's a massive factor in India. Even though agriculture's share of the overall GDP has declined over the decades, it still employs a huge percentage of the population.
And it's rain dependent.
Hugely dependent on rainfall, yes. We essentially have two main monsoon seasons that dictate the agricultural cycle.
Which are?
First is the main southwest monsoon, roughly from June to October. This is critical for the Kharif crops.
Kharif crops like?
Rice, cotton, soybean, sugarcane. That's the big rainy season crop. Then you have the northeast monsoon, sometimes called the winter monsoon, typically December to March.
And that's for rabi crops.
Exactly. Rabi crops like wheat, barley, mustard, gram. Understanding these cycles, the timing and distribution of rainfall, and the progress of sowing and harvesting is absolutely crucial if you're trading agri-commodities in India.
So which specific agri-commodities are actively traded on MCX? Where's the liquidity?
For reasonable liquidity, the two that are generally recommended for active trading are cardamom and mentha oil.
Cardamom and mentha oil. Okay. And trading hours are different.
Yes, that's important. Agri-commodities on MCX trade until 5:00 p.m. IST, unlike the non-agri commodities like metals and energy, which trade later into the evening.
Okay, 5 p.m. close for agri. Now, cardamom, isn't India a huge player in the global market for that?
It is. India is actually the world's largest consumer of cardamom and the second largest producer after Guatemala.
The queen of spices.
Indeed. And being a Kharif crop, its price is significantly influenced by the southwest monsoon performance, the quality of the crop, and also global stock levels.
Contract specs for cardamom.
The lot size is 100 kilograms. Tick size is 10 paise,
Okay.
0.1 rupees, and the P&L per tick is RS10.
Okay, 100 kilograms, RS10 per tick, and mentha oil. What's that used for?
Mentha oil, derived from mint leaves, is widely used in things like toothpaste, chewing gum, candies, pharmaceuticals, cosmetics.
Right, that minty flavor and smell.
Exactly. Its price is sensitive to factors like the USD-INR exchange rate as it's exported, rainfall patterns during its growing season, and potential damage from pests or diseases.
And the contract.
The mentha oil contract has a lot size of 360 kilograms. Tick size is 10 paise, and the P&L per tick is RS36.
360 kilograms, RS36 per tick. Now, practical question about agri-commodities. Why are there generally no MIS margins available for them? Why can't you get that lower intraday margin?
Yeah, that catches people out sometimes. MIS stands for Margin Intraday Square Off, which offers lower margin rates because the broker ensures the position is closed before the market shuts.
Right.
The reason it's typically not offered for agri-commodities is mainly due to their potentially high volatility and the fact that they frequently hit daily price limits or circuit limits.
Oh, they get frozen.
Exactly. If a commodity hits its upper or lower circuit limit, trading stops for a period. If that happens near the end of the trading day, it can become very difficult or even impossible for the broker to square off those intraday MIS positions before the 5 p.m. close.
So it's a risk management thing for the brokers.
Precisely. To avoid getting stuck with open, unmargined positions overnight, they generally require full overnight margins, known as NRML margin, even for intraday trades in agri-commodities.
Okay, that makes sense. Let's circle back to energy briefly and talk about natural gas. What's its role in the modern economy?
Natural gas is another major fossil fuel, primarily composed of methane. Its uses are widespread.
Like what?
Electricity generation is a huge one. Industrial heating, residential heating and cooking, and it's also a key feedstock for producing fertilizers, plastics, and other chemicals.
And it's odorless naturally, right?
That's right. Pure methane is odorless and colorless. So utility companies add a chemical called mercaptan.
The stuff that smells like rotten eggs.
That's the one. They add it deliberately so that gas leaks can be easily detected by smell for safety reasons. Interestingly, India is actually the 7th largest producer of natural gas globally.
Now, we already discussed the amaranth gamble as a cautionary tale. Can you just quickly reemphasize the core lesson from that $6 billion loss, specifically in the context of natural gas?
Absolutely. The amaranth story is a stark reminder, particularly in a market as potentially volatile as natural gas, which is heavily influenced by weather forecasts.
Which can change rapidly.
Exactly. The core lesson is the danger of excessive leverage combined with overconfidence in a single outcome or prediction. Amaranth bet huge on specific weather patterns driving prices up. When that didn't happen, the leverage destroyed them.
So don't bet the farm.
Don't bet the farm, manage your position size rigorously, have exit strategies, and respect the market's potential to do the unexpected. Risk management trumps prediction every time in the long run.
Got it. What are the contract specs for trading natural gas on MCX?
Okay. On MCX, natural gas is quoted per million British thermal unit, or MMB2. That's the standard energy unit.
Me too.
The lot size is 1,250 MMB2.
250.
Yep. The tick size is 10 paise, 0.10 rupees, and the P&L per tick works out to Rs of 125.
Okay, Rs 125 per tick. Margins.
Margins for natural gas are typically among the highest in the entire commodity market, often around 15% or even more for overnight positions.
Why so high?
Primarily due to its inherent price volatility driven by weather, storage levels, and global supply-demand shifts.
And its price tracks.
MCX's natural gas futures prices closely mirror the benchmark prices set on the New York Mercantile Exchange, NYMEX, specifically the Henry Hub natural gas contract.
And key drivers to watch.
Definitely the weekly natural gas storage report from the EIA in the U.S. U.S. weather conditions and forecasts are huge, especially hurricane predictions in the summer and cold weather forecasts in the winter. And historically, there's often been some correlation, though not always perfect, with crude oil prices as well.
Okay, now let's look to the future, quite literally. It's really exciting news that commodity options are finally set to launch, or have recently launched, in India after years of waiting.
It is. It's a really significant development for the Indian commodity markets, adding another layer of trading and hedging possibilities.
How are these different from the equity options people might be familiar with?
There's one absolutely crucial difference in the underlying asset. Equity options, like Nifty or stock options, usually have the spot price as their underlying.
Right.
Commodity options in India, however, are structured as options on futures.
Options on futures, what does that mean?
It means the underlying asset for, say, a crude oil option is not the spot price of crude oil, it's the crude oil futures contract itself.
Ah, okay, so it's one derivative based on another derivative.
Exactly, a derivative on a derivative. And this has practical implications. For instance, you can't use the standard Black-Scholes option pricing model that works for equity options.
Why not?
Because Black-Scholes assumes the underlying asset, the spot price, doesn't have carrying costs like futures do, storage, interest, etc. So for options on futures, a different model called Black 76 is typically used for pricing.
Black 76. Okay, so how will these commodity options generally work in practice? Lot sizes. Style.
The lot sizes for the options will be the same as the lot sizes for their corresponding futures contracts. So a gold option will have a 1 kilogram or 100 gram underlying, depending if it's based on big gold or gold mini futures.
Makes sense.
They are likely to be or are structured as European style options.
Exercise only at expiry.
Correct. And just like other options, margins will apply if you are writing or selling commodity options.
Okay, I heard there's a new term involved too, close to money. CTM.
Yes, that's a specific term introduced for commodity option settlement. Close to money, or CTM, typically refers to the two strike prices immediately above the at-the-money ATM strike, and the two strikes immediately below the ATM strike, so 5 strikes in total, including the ATM.
Okay, the ATM and 2 on either side. Why is that important?
It's important because of how settlement works at expiry.
How does settlement work? Does it automatically convert to futures?
It depends. For those CTM options, the option holders, the buyers, will need to give an explicit instruction to the exchange before expiry if they want their option to devolve or convert into a futures position.
So you have to tell them you want the futures.
Yes. If you don't give that instruction for a CTM option, it will be deemed worthless and expire, even if it's slightly in the money.
Okay, that's crucial. What about options that are further in the money? ITM.
For ITM options that are not CTM, so deeper ITM options, the settlement is usually automatic. They will automatically devolve into a corresponding long or short futures position at the strike price, unless the holder gives a specific contrary instruction not to exercise. For example, maybe the option is slightly ITM, but after accounting for brokerage, taxes, and the futures margin, taking the futures position wouldn't actually be profitable, so they might instruct not to exercise.
Okay, so CTM needs instruction to exercise. Other ITM needs instruction not to exercise. Got it. What about margins when these options expire and potentially turn into futures?
This is another really critical point for anyone trading these options, especially selling them. As options get closer to expiry,
Yeah.
the exchanges will start assessing which options are likely to end up ITM or CTM, and they will begin assigning what's called devolvement margin or pre-expiry margin on those positions.
Margin before it becomes a future.
Exactly. You'll need to make sure your account has enough funds before expiry to cover the full margin required for the futures position that your option might turn into.
So you need the futures margin ready in advance.
Yes. The exchange anticipates the conversion and makes sure the margin is there. Generally, the deeper in the money an option is, the closer its delta is to 1, and the less additional margin will be required at expiry because the option premium already reflects much of the intrinsic value. But you still need to be prepared for that full futures margin requirement.
Okay, that's a very important operational detail. Wow, we've covered a huge amount of ground here.
We certainly have.
We've really done a deep dive, haven't we? Through this whole fascinating, sometimes quite intricate world of currency and commodity futures. From, the ancient origins of currency right up to the modern mechanics of trading oil, gold, and even looking at these new commodity options.
Yeah, and if we connect this all back to the bigger picture, the hope is that you, our listener, now have a much deeper appreciation for the fundamental forces that are constantly moving these global markets. You can hopefully better grasp why seemingly unconnected events, a Brexit vote in the UK, or a hurricane hitting the US Gulf Coast, or an interest rate decision in Delhi, can actually have a direct impact on the prices of these assets.
It's all interconnected.
It really is. And having that understanding equips you to approach these markets with a more informed perspective, moving beyond just gut feelings or speculation. You're not just sort of passively observing the news anymore. You're starting to understand the why behind the headlines.
Absolutely. Our goal today was really to give you plenty of those aha moments, those key insights and details. Because it's not just about memorizing facts, is it? It's about empowering you with a sense of clarity, maybe some confidence, in navigating a financial world that, let's face it, often feels overwhelmingly complex.
Couldn't agree more. And perhaps as a final thought for you to ponder as you go about your week, now that you have this deeper sense of how interconnected global economic data is, everything from interest rates and trade deficits to inventory levels and even weather patterns, how might that change the way you interpret the daily headlines and the market movements you encounter from now on? Something to think about.